Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jared Stoutmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Hey everyone, welcome back to the Active Turnkey podcast. I'm your host, Jared Stoutmeister, here with Tom Olson.
Who wrote the book, Active Turnkey.
Wow, I'm here with the author.
The author
of the book.
Called Active Turnkey.
Active Turnkey.
That's why we're called the Active Turnkey podcast.
It is. And so I feel privileged to be here just in the same
you know what's funny, Jared, is like we always have a plan when we start these podcasts.
We do.
Right?
Mm-hmm.
And by minute 2, we already kind of get derailed.
Yeah.
I don't know whose fault that is.
I have an idea. I have an idea.
It's probably my fault.
I have an idea.
Jared said we're going to plug this book at the end.
I did.
And then what did I do? I just went ahead and just
does the opposite.
Said, look, Active Turnkey podcast. I don't know.
But he's the boss.
Yeah, I don't know.
And that's okay.
I think somebody needs to fire me.
This is not the place for us to have a kind of
a boardroom conversation.
Yeah, that's another podcast.
How do you fire your boss?
Right. And
okay. Well, that's what we're talking about, right? How do you fire your boss? How do you get enough active turnkeys?
Wow.
Right?
This guy's been on a lot of podcasts.
Yes, we are on fire today, Jared.
Segued right into to do that. Yeah,
so
he's feeling it.
Yes,
he's feeling it. So today's podcast should be interesting for those of you who are actually seasoned investors who have been investing for a couple years, because you're going to run into a problem.
Like you.
Soon, yeah, that's true.
Yes,
we will be. Yeah. So pretty soon for me, not yet, but pretty soon. Well, actually, no. So this is where it sends you. Well,
I'm like you're right there. What do you mean? Like, yeah.
Well, no. So here we go. Today's podcast is what to do.
What is today's podcast all about, Jared?
Here we go. What to do when you have 10 conventional loans.
Oh, boom.
Yeah, so you're an investor. You bought turnkey properties. You're getting conventional financing. Or maybe you did active turnkey. You got the BRRRR method. You did the cash out refinance. And now you have 10 conventional loans.
You got my wheels spinning, Jared. We didn't talk about this, so I don't know. I have no idea this was coming.
He's shocked.
And now I'm trying to figure out what in the world do you do?
He's shocked right now. So now you said I'm not quite there, because actually my dad and I do it together.
Oh, that's right. Okay.
So we do have some slots.
That's true.
So right away that kind of gives an answer to the first one, right?
Oh, wow. I didn't even think about that.
The first one.
You could get a partner
or a family, a spouse.
And a spouse. So like really,
that's the classic way.
I think this all comes from like the Fannie Mae Rule. So
Correct.
Really like Fannie Freddie, they say you're allowed to have 10 golden ticket slots, right? Mm-hmm. And you know, I think even back up with that, I do think these are golden tickets. And I'll be honest with you, like for the rates that we're seeing right now in the low 3s, I mean, if you're not thinking about buying real estate as part of your portfolio. You know, I was listening to a show over the weekend, and they said the top 1% of people, they have 26% of their total overall portfolio in non-traditional assets. And when they say non-traditional assets, they basically mean real estate. It has something to do with real estate in those non-traditional assets. And so they obviously have some small portion of gold. They've got, and they only have 20, like I think it was a larger percentage in real estate than it was even in stocks. You know, so for most of us, we get taught, you know, go to school, get a really good job, invest all your money in 401ks, and then like people finally learn, oh crap, real estate's a whole lot better. And I think sometimes we put all of our eggs in that real estate basket, and and I think it's better to do that than to probably put all your eggs in the stock market,
sure.
Or all of your eggs in gold, or all your eggs in overfunded life insurance. But I think it ought to be a part of your portfolio. Real estate should be a part of your portfolio. But there are these 10, what a lot of people call golden tickets, which basically means you can get those 10 government-backed loans as an investor that will give you the best rates, and you're basically leveraging. You're almost shorting the dollar over the next 30 years. And who thinks the dollar is going to be worth less money in 30 years than it is now?
Well, most people should.
Do. So I have my hand raised. If you're not watching this, if you're listening to the podcast, you know, I was actually on another call today with my mastermind, and I actually had a gold expert on there, and he talked about right now we have like I mean, we just added $3 more trillion to our debt of our country. We're at 136% of our GDP in debt. You know, so like that should not be like, you know, we shouldn't have that in our personal finance, and we shouldn't have that as a country. Sure. So what does that mean? That means the dollar's going to be worth less. And I think, you know, having these golden tickets, having these 10 slots is very important. And it's kind of funny because sometimes we even just experienced this with another person that works for us. He actually went out and started going into these other lending programs because he was told at a RIA, at a real estate investment group, that it's better to go get these private money companies or what we're gonna say is more of a commercial bank, instead of going and getting the Fannie Mae loans. And I'm like, no. You need to get those Fannie Mae tickets first. You know, focus on them first, because like, yes, I agree, there's lots of other ways to find money, and sometimes they're a little easier than it is to get Fannie Mae, but I do think it's worth the point to say, if you haven't used these, like, use them up. Sure. The other thing I would say before we get into like what to do once you get to 10, because I think that's really what the podcast is all about. But the other thing I think you ought to consider is, you know, a lot of our properties are really cheap and they're really low end. I think if you can, I think it does make a little bit more sense if you can figure out which ones you wanted. Like if I were to choose in my first 10 properties, which ones I'm going to use for Fannie Mae versus which ones I might want to use with the commercial lender, I would probably use the cheaper properties with the commercial lender. And I'd probably go with like my fourplexes or my duplexes, or the ones that are going to give me the biggest bang for my buck with that cheapest money. Sure. So just to kind of preface everything with that, like I know a guy who bought like 2 or 3, 4 units when he started with the Fannie Mae slots, and then went right away to commercial lending. You know, when that happened. So the question is like, what do you do once you get there? I kind of like we're leading up to that,
right.
And letting everybody know how important those super cheap, you know. And now obviously you need to highly qualify, and the qualifications have gotten a little bit stiffer. They've loosened up a little bit over the last month or so with some of those qualifications. But even though they've loosened up with some of the qualifications, like the vetting process seems like it's continuing to get stricter and stricter. So just know that, you know, at the end of 2020, where we're at now, that's where we're at now with these types of Fannie Mae, Freddie Mac type of loans. But once you get to 10, Jared, what are you going to do?
That's a good question. So a couple different things. Well, first of all, like I said, so once I get to 10, most likely my dad and I invest together. So most likely he'll be to 10 too. So that's the key. If you really want to scale in that way, you can partner up with somebody, or you can go with a spouse. So that's probably the best way to go, right?
I think, and I actually agree. So like your spouse is normally a really good way to think about this. And a lot of you guys might own a business, and maybe you can find a spot for your spouse to work in that business. And you know, they have to get paid, and I'm not trying to like say that you should just pay them and not let them work, but they do have to have income in order to be able to qualify for this. So if they can do something for your business that does constitute, you know, value, then that is one thing that you can do. Or maybe they already have their own career, and you know, a lot of people, their wives do something completely different than they do. Or maybe you're a woman listening and your husband doesn't do real estate, but you do real estate, but your husband, maybe he's an engineer. You know, you can obviously get 10 from you and 10 from your spouse. I would highly recommend against doing these joint loans with your spouse. Like that you're kind of lose 10 tickets, you know, 10, you know, these super cheap government-backed 30-year amortization, you know, mortgages. And we won't get into all the benefits of that today, because it's probably another podcast that really talks about how you really make money long term. And one of those ways you make money is the actual debt that you're using, the structure of the financing to make it happen. So yeah, once you get to 10, the very first one that you know step, you've got many. I think you have many choices. I think some people get to 10, they're like, I'm at 10, I'm done, I can't invest anymore. Sure. And you know, there's really a lot of options, you know, there. So the first one that you mentioned would be either add a partner to the deal or a spouse. Right.
And I've worked that way with some investors who have bought from us, and they go to the lender, and the lender basically tells them same thing. So if you work with us, we have some preferred lenders or some people we recommend who do good work. And that's what they'll tell the buyer: hey, you got to get your spouse working. You got to get the slots available. And that's good counsel even from them. They understand what you're trying to do. So yeah, you want to get those slots working for you. And if you have 10 gold tickets, then with your spouse you have 20.
10 plus 10
tickets.
is 20. I mean, we're in elementary math here.
Yep.
I think most people that are listening to this can figure out.
Yeah, it's exciting. So you doubled your gold tickets. That's another way to put it.
I like it. Yeah.
So, all right. So that is the next step, is either through your spouse or through your partner in that case. And in this case, like for I.
Now, once you get to 20, you have 20 leveraged properties. You know, you think about it. If I have 20 leveraged properties, and let's just say on average, each one's kicking off, $300 a month. So $300 a month times 10 is 3,000, and then 300 then 3,000 plus 3,000, 10 is $6,000 a month. So at this point, I'm at $6,000 a month. That's what I'm hoping that at least that I'm kind of like kicking off each month. If you think about it, if you just waited 10 months and just saved up that cash, you could buy the next one with cash. So that's obviously an option as well. And
totally.
I'll be honest with you, personally, my recommendation for people is that they don't pay off all of your properties at once. So let's just say that you wanted to use that $6,000 and pay off your properties. Don't use $6,000 and pay off $300 on each property every single month. There's nothing you can do that will be worse for, as far as a pay down goes, there's nothing that you can do that will be worse for it than that. Other than, like I said, if you just don't do anything at all. But if you're actually using that money to pay down, don't do that. I would recommend one of two options. You either spend all that money and pay one down, all right, and create this snowball effect. Because, if you think about it, you could just pay one off and then you have another open slot. But every time you finance a new property, you have to know that there's closing costs. Absolutely. And it's going to cost you a fee. It's going to cost you money each time. But every time you do a cash closing, everything is cheaper. The closing costs are cheaper. So you might go from $2,800, $3,500 worth of closing costs down to $1,400, $1,200 worth of closing costs if you're paying cash. So understand there is some wisdom in cash, and me personally, I would tell you, I would rather see some of yours as highly leveraged as you possibly can, get as much money as the bank will give you, and then have these others in cash rather than having even a 50% overall portfolio. I think it makes no sense. I hear some people out there and they're boasting that their leverage is 50% on all their properties, and I think that's the stupidest thing that you can do. I'd rather tell you to have 100% or 80%. Even if you can get 90%, do a HELOC and get 90% if you want to. Get as much leverage as you possibly can on a part of your portfolio, and then have cash with another part of your portfolio. So that's another option. And I actually think for me, that's probably one of the smarter things you can do is as quick as you can get those 20. 20 is a significant amount of cash flow. And then once you get that, you can kind of have something else to kind of work with. And I think cash is the next way to go, or you can do the pay down thing. People have different goals. And for some people, $6,000 is all they need. Right. And that's I've heard lots of people that's probably the lowest I've heard of somebody saying this is my financial freedom goal is $6,000. But most people I talk to are somewhere between $10,000 and $20,000 a month is really what they want kicking off. But if you think about it, if you just started using that $6,000 to start paying off, you probably would have those all paid off in about 9 or 10 years. And I've even done a whole spreadsheet on that and shown people you could literally have 20 free and clears within a matter of 9 or 10 years. And think about it. At that point, you're no longer kicking off $300 a month. You're kicking off probably between $700 and $800 a month. So now we've got 20 properties kicking off $800 a month. Well, now we're at $15,000, $16,000 a month, and that's significant. That most people can live on that.
I think so.
I would hope. Not everybody. Yeah. I know people that are no, Tom, I can't live on less than $20,000 a month, and God bless you. But that's not where most Americans live. But if you think about it, if you had 20 free and clears, that could get most people there. And I think sometimes less is better. So again, it all depends on your and guess what? We sell these. So like by me saying this is really looking out for your best interest. I'm not looking out for because my best interest would be to like, I want to get you to 100 and I want to get you to 1,000. I want to you keep buying properties from me. I get it. And everybody has their own goals. Sure. You know, I know one guy, you know, he was an engineer and he worked and he worked and he worked and he got to 100 properties before he quit his job. 100 leveraged properties. Wow. Now he's leveraged. Wow. They're all leveraged, and he just kept buying more leveraged properties. And you know, so for him, the way he looked at it is like he knew he could count on $100 a month for each property. Like that's what he could actually count on. Not like what he hopes he's kicking off, but like 100%. Like he knew he could for sure count on that. And he says he makes way more than that, but that's what he was basing everything on. And his properties are mostly in California, so like he in areas over there where it still does. There are some areas in California it does make sense, but like so for him that's what he was looking at. And you know, since he retired and went into more full-time real estate, now he's like at 180, 190 properties. But really, you know, like he didn't really feel financially free till he had 100 leveraged properties. But I think it would have been different if he would have thought about, well, how many of these are free and clear? If, you know what I mean? So I think it's definitely an option is cash.
Definitely. And then like you said, as soon as you buy that 11th house, now you have more cash flow coming in because you don't have a mortgage to pay on that one. Exactly. So it'll just speed you up even more, maybe by the next one in cash.
And honestly, I've heard both. I've actually heard both sides of this coin. You know, some people think you should buy all your rentals in cash. And you should just go all in cash. And you know, to me, I don't. I feel like you're missing a big key component of the U.S. dollar. And honestly, and I hit that a little bit at the beginning. And having a 30-year mortgage, it's almost like they're giving you money now. That is going to be devalued in 30 years, and you don't have to pay it back for 30 years. So, you know, just as much as I can go to the store today and buy a steak for so much money, in 30 years, I'm going to pay a lot more money for that steak. I'm getting the benefit today, and on top of that, you get tax write-offs from it, and it, to me, it really does make a lot of sense, especially now when the rates are so cheap, to take advantage of them, as many of these as you possibly can.
Well, you're right. So like our first property that we bought together was a cash deal. My dad and I were about 22 all in, and it's been a few years. So now it's pretty much paid off, and we were talking about getting financing, but it just didn't make any sense for us to do that. Well, you just decide to use that slot for a different property.
Right, it does. Sometimes it doesn't. You've got it 100% right.
So, okay, so that's the first one, cash. So you have your 10.
The first one was a partner. Or
you
your
have a partner.
spouse.
Forgive me. You have a partner or spouse. Second one, you have your 10 or your 20, and now you have all that cash and you're putting it into a cash deal. So now you don't like that option. You don't want to put $40,000, $30,000 into a property. You want to put that into another leverage deal. What are your options?
Well, I mean, there are still options out there. I think one option that most people go to next is a commercial lender. So. And I think working with a commercial lender, there's a couple options at this point. You know, commercial lenders at this point, and these are like your lending ones, your Lima ones, your RCNs, there's a lot of companies out there that are kind of in this private soft money space. And actually, like, I'll be honest with you, I'll give you a secret here. You know, the cheapest commercial lending is probably your local banks and your local small little 3 or 4 branch banks, and even credit unions. You know, like you know, if you can get a relationship with your small local banks, your even small regional banks, credit unions, a lot of times they've got discretionary funds and discretionary money that they can use, and they want to own in their little locations. Sure. Like they have roots, you know, rooted, and they do want to own in those specific areas. So and they like having assets on their books, which makes them look better to investments, best investors, if they want to grow and get larger later down the road. So, you know, commercial lending is the next step for a lot of people, and at that you're just going to pay higher rates. I mean, instead of paying like 3%, which you're going to get now, right now you're probably looking at like 6.25% for those types of rates. And I've even seen some commercial lenders as cheap as Fannie Mae loans. So, like for some people, it doesn't make a difference. You know, I know for a while. One of the big banks, not Bank One, but one of the big banks, the one that we actually just lost a bunch of, what is it?
U.S. Bank?
U.S. Bank. For a while, I was seeing U.S. Bank loans like at the same rates as Fannie. I mean, I was shocked, and their closing costs were even cheaper than Fannie. So I was like, I was, you have to do a lot of research, and you have to really reach out to a lot of different lenders to find the people that you can find. And we've done a lot of legwork and try to find a lot of different lenders for people to be able to invest in. I mean, there's even an option, like if you have an IRA, for instance, you have to then have, if you're investing with your IRA, you have to have a special type of lender that will allow you to loan, to borrow from an IRA, because it has to be a non-recourse loan. And a non-recourse loan typically is going to require at least 40% down, so you're going to have more down. But again, that money's got to come from the IRA, and there are several banks that we know that will loan from your IRA as well. So I don't know that we planning on talking about IRA lending, but obviously that is another way for you to get money. If you have a 401k and you've quit a job, you can move those funds to a self-directed account, and you can use those funds to be able to invest in this as well. And now obviously it needs to stay in your IRA, and if you do sell it, the proceeds come back to your IRA. And you don't really get the tax benefit if it's in an IRA like you do outside, because you can't really depreciate. You don't really get all these extra benefits that you would get in an IRA. Now you do in a 401k, and I'm not going to get into IRA 401k law today. Maybe that we should actually have an IRA custodian on and talk about turnkey rentals with inside of an IRA. But if you don't have a self-directed IRA, let me just tell you to do it. Go out and find, my preferred custodian is Quest, but there's some really good ones out there. Cama Plan's really good. Equity Trust is really good. There's Midland. There's a bunch of other ones around the country that you can find that will help you with self-directed IRA investments. But so really back to what we were talking about. Once you get to 10, first number option is a partner or a spouse. The second one I would say is cash, and then the third one is commercial lending. And you have a bunch of experience with commercial lending, Jared. Anything else you want to add about the commercial lending option there?
No, you're right. It seems like the just more here recently, it has become a little bit more difficult, and so normally you think it's easier on that front, like you're describing. So a lot of times the conventional loans can be easier. Now, the one thing to kind of piggyback on that is when you have somebody who's systemized and they're on your side of the deal, like they're trying to help the investor. From conventional financing standpoint, they do make it easier for you than just going to somewhere else where you're just off the street and it's painful. That's usually what they say is painful, right? So now with commercial, it's supposed to be less painful, but recently we have seen that it's been.
They're asking for a lot more stuff than they used to, and it's getting almost as painful as Fannie Mae, Freddie lending. I can give a quick referral in this. I don't think we don't have a ton of people that we can refer, but I have a broker that has a lot of different relationships around the country, and he's in my mastermind. So I would we push the people in our mastermind for your Fannie Mae deals, and I think these are the best in the country. And really, like, we found these people, and everybody else that has talked to Aaron or Jerry just loves working with them, and we do promote them for the Fannie Mae deals. But there's a guy named Damon who's in my mastermind, and his company is Loan Bids, and he has a website called loanbids.com. And if you guys do go there, just make sure you let him know that Tom Olson referred you, and he'll take really good care of you in that kind of commercial space as well. And they actually have another product, which I would even get to next as well, on our list, which is a portfolio loan.
Let's do it.
So the next step I would say would be, so yes, you can do partners, you can do cash, you can do commercial lending at this point, or you can get into a portfolio loan. And a portfolio loan could be, you could take action on a portfolio loan probably one or two ways at this point. Number one, what you could do is you could refinance all of your current portfolio. And I mean, I think there's an argument on both sides of that, whether that's the smartest thing to do, or whether it would be to just go and buy 9 or 10 more all at once and buy it with a portfolio loan. So you've got to determine what's better for you. I have seen people, show me on paper how both ways are right. And so I don't even really have a super strong opinion, honestly, on it, but I just know that these are your options, and this is what this podcast is all about, is your options. So at that point, you can, if you had 20 loans, say, you and your spouse or you and your partner could then go and refinance all 20 into one portfolio loan. And most portfolio loans, they want at least 9. I don't know why 9's the magic number.
Interesting.
But for some reason, they normally want at least 9 properties in that portfolio, and or you could call it a blanket loan. And I know there's a different terminology for a blanket loan than a portfolio loan, and they're a little bit different. There's a couple things to think about when you're getting a portfolio or blanket loan. First of all, are you going to sell these loans? Are you going to sell these properties or any of these properties in the near future? Because you have to kind of know that in some ways and in some loans, you have to read your docs and understand this. Sometimes they're going to want to group these all together. And if let's just say you sell one property, they may not give you any of that cash at all. They may say, I want all that money has to go back towards the principal. So you have to just be okay with that. And it's going to pay down your loan. So you have to know what that looks like. The other thing you have to know is if there's prepayment penalties. A lot of times, even in commercial banks, you got to know that as well. In the commercial lending, sometimes there's a 3-year period of time where if you were to sell this property in the next 3 years, they're going to charge you a penalty. And this is way more prevalent in the portfolio and blanket loan type of things. You have to kind of understand they're almost kind of like sharing this big pot. It's one big loan for 9 or 10 or 20 properties. So some of the lenders are not too keen on you kind of taking some of these properties out.
Sure.
And a lot of times the reason is because what they're doing to the loan on the back end, sometimes they're selling this loan to a hedge fund. They're selling this loan to an insurance company, and the insurance company wants the stability of the whole thing. They don't want it to be messed up, because then guess what? The reason why they'll do the portfolio loans is because they can give you $1 million all at once, and they don't want, these insurance companies don't want $100,000 back. They want to keep that that $1 million out. So you have to understand what you're doing as the owner of these properties also affects other people in your lender, you know what I mean, so to speak. So make sure that you understand what your particular commercial lender or portfolio lender or blanket loan, make sure you really understand the details, because it's a little bit more complex than just a one-off type of deal.
Now, to help that, the way that I would help understand that for me is, because I'm not experienced with that part of it, sounds a lot like people who want to send us maybe some longer term money. Like where we used to do loans, like a 3-year loan for a lease option type deal. Is that kind of the same principle where they want their mailbox money, more or less? Okay. Yeah, that makes a little bit more sense. But it's just in
a bigger chunks.
Sure.
I think a lot of what we're talking about is we are the really small fish in this. I see a lot of, it's so funny to me. I see these guys in the RIA, and, they pump their chest because they're doing 80 deals a year, and they're just so awesome. But there's guys out there that they won't even do a deal unless they're buying 80 doors or 100 doors at a time. Right. And then beyond that, there's people that won't do deals unless they're buying 1,000 deals at one time. It's, I've seen this this graphic before. It's we got this little fish, and that's really who we are. We're this little fish, and then you got this other guy that's going to come around. And he's going to eat that fish, and then there's another fish that's going to come in, and then beyond that, you even have the Fed, who it's they don't do nothing unless it's billions of dollars before they want to move money. So, I'm trying to explain. There's a lot of different things that play here, and we affect the economy in many different ways. But the most important thing that we do is we provide affordable housing for people. So, and that's what I love about our business so much. Is that emotional paycheck that I get, because I know I'm making a difference in my community. And then on the backside, any money that I make, I know I've got a giving board right outside here in the office, and I can go and look at every single day and say, you know what, this is really why I'm working. I'm really working so I can give on the back end. And it is very personal to me, the mission here in Gary, Indiana, but it's also personal to me on even the money that we make goes and makes a difference in other people's lives and in other people. So really, I have we hit up all the different things? So we've got number one, obviously you want to hit your 10 tickets, your 10 golden tickets. Yep. As soon as you hit your 10, to get to 20, you can add a partner. And really, if you think about it, you could really get to 30 if you want to add a third partner, or 40 or the fourth. I mean, that is another way. And then after you added a partner or a spouse to this, you can go cash, which I think has wisdom in it at times. And then I think you can also go to a commercial lender, or you can go to a portfolio lender or a blanket loan or something like that. There is something I wanted to talk about, the blanket loan. so you have those two options. I wanted to highlight that again. You have the option of either opening up all your 10 slots and just refinancing all those 10 or 20 that you have, and then getting new Fannie Mae. Or if you think about it, like let's just say in the next 10 years, right now you've got all these slots like full at 3%, and then in 10 years, maybe Fannie's at 5% or 6%. And then like your commercial loan's at 6%. Like it might really make sense to just go to the commercial loan at that point, instead of like refinancing these 3% that you've already got 10 years paid down, and now you're really starting to multiply how fast you're paying things off. So at different parts of the cycle and at different parts of where you're at in your life, it might make sense in one way or another. So, and then I think the last one, and maybe there's something else that you know of, Jared, but I would tell you the last thing that you can do, and this is where some of the active investors kind of go to, is private money. Yeah. There are private money lenders out there that will pay you, that will let you take their money secured by real estate, and they will be totally fine with 6%. I've even heard of a private lender doing 4%. They're not super prevalent. Wow. I'm not one of those lenders, so don't come to me asking. I do loan my money out.
5? We do 5.
I call my money hard money, Jared. You know why I call it hard money? Because it's hard.
Yeah.
It's not easy.
I know this.
It's not soft. But just be honest with you, like, so there are different. If you think about it, like if you have your money in the bank right now, what are you earning?
Hold on. I'm not earning
not much.
Yeah.
Like it's like less than 1/10 of 1% in most banks. Now maybe there's a CD or money market that more sophisticated people might have, but there are a lot of people out there that are literally earning nothing on their money. And if you're in some other countries, which may come to the United States at some point, they're getting negative interest rates in the bank. So if they put the money in the bank, they actually have to pay the bank to put their money in the bank.
Nice.
I was on the phone call today with McAvaney Precious Metals, and they actually believe that may happen in the United States, and it may happen sooner rather than later. So if you think about it, like, you're not. The difference between making nothing and 6% is a lot.
Yeah.
Especially in percentage wise. So to even keep up with inflation at this point, maybe that 6% is at least enough to keep up with what we're going to see for inflation. I'm not sure if it is or not, but there are people out there that will do 6 or 8% or whatever, and you can just do private money, and I think that would be probably round out the different options for people that would want to try to do something after they get to those 10 golden tickets or 20 golden tickets.
Yeah, Aaron Chapman, one of our lenders we recommend, he's been on our podcast here before. He talks about the idea that when you put your down payment on a property and don't buy a boat, you don't lose the money. You just moved it from one spot to another, and you have an asset. So in that illustration, if you're ever in a point where you're losing money by putting in a bank, you might as well put in a property and make some money on it. That's
and at least not lose it.
There you go.
Right. You want to put it in gold. You might want to put it in something else. If you look over the last 100 years and you look at what gold used to buy you versus what gold buys you now, it buys you the same amount. Gold, back in 1920, 1 ounce of gold would buy you a really expensive suit. Okay, and that was $20. It was worth $20 for an ounce of gold. Now, an ounce of gold is like $2,000. Well, guess what? What does a really expensive suit cost? A custom tailored suit is around $2,000. So, like, if you think about it, it costs that pretty much holds its value over time, where the U.S. dollar and most of our currency that is not really backed by gold or anything, it has not held its value. I mean, I can tell you, I remember, when I was just a kid versus now. I mean, 20, 30 years ago, our dollar's being devalued quicker now than it ever has been, especially with all the stimulus that's going into the economy right now. I mean, we've already put over $3,000 this year, and I would almost bet there's going to be at least another $2 trillion, maybe $3 trillion that goes in that just goes into the United States debt in the next year. I don't care who wins the election. It doesn't matter if it's pre or post. It's going to happen. To me, I think it's a foregone conclusion whether or not it happens before the election or after the election. If it happens before, great. If it happens after, great. Whatever. I don't care when it happens. I just know it's probably going to happen.
So all these different things, all these different options, you want to be looking out for. And again, as you start approaching your 10, I've had a couple of investors recently who didn't realize, they kind of fell upon the idea that, I actually got my 10. So you want to keep aware, keep a board next to your desk at your home office, and just keep track of how many conventional loan slots you have. And when you get to that 10, these are some decisions you want to make, some options you want to have. And hopefully this podcast brought you back value. Now, this is the time in today's podcast when Tom is supposed to show you the Active Turnkey book. Yeah. So, Tom, this is your cue. So,
if you guys want to read more about Active Turnkey and kind of like where we got this whole concept, you guys can read this book. You guys can go to goodsuccess.com and get it. You can you can pick it up on Amazon if you want to, but goodsuccess.com would be the other place that you can pick up that book from us. And the other thing that I love to talk about is we have this YouTube channel that we're really trying to help promote and let other people know about turnkey rentals. And really, like, there's a lot of podcasts out there, Jared, that talk about turnkeys. But I've heard a lot of them, and it seems like the only thing they talk about is the economics around it. All they talk about is like how much money you make for rent and how real estate is the best investment vehicle of all times. And I think some people do a really good job, but what we decided we wanted to do was we wanted to really try to get down into the nitty gritty and really try to teach people what the real experience is like and give you the confidence to go out and make that first deal happen. So if you guys are interested in something like that, remember that we do build rental portfolios for investors. That's really what we do. My goal is to flip the city of Gary, Indiana. So we are right now investing in Gary, Indiana, with our own properties and with our turnkey rental properties as well. We're seeing massive changes in the city right now, and I'm glad to be a part of that solution instead of being a part of the problem that's been in Gary for many, many years. So if you guys are interested in us helping you build a rental portfolio, you can reach out to Jared. Absolutely. And Jared would love to help you with that.
Yes, you can reach me at jared@buyolsongroup.com, or you can go to our website, buyolsongroup.com. And one more thing I'll throw in there. We were at a IMN event last year, and one of the guys up there mentioned the idea that if you are investing and using a property manager who's not investing himself in real estate, you probably shouldn't be using that person. And we do that here. So locally, I'm just starting my personal journey. Tom's been investing for years. And so, and we believe in the city of Gary. So we are investing ourselves personally in the city of Gary. So we believe in our market. We believe in Gary and what's happening there. So if you're looking to jump in, we have some good opportunities, and we'd love to try to help you with that as we, again, do build rental portfolios for investors. So if you don't have anything else to add?
No, I started to mention the YouTube.
You almost,
but
you were
please,
right there.
if you guys could do us a favor and share, so subscribe, click subscribe on the YouTube right now, or iTunes, or however you guys are listening to this. Please give us a 5-star review. That would really help us out a lot, and we would really appreciate it.
Active Turnkey,
the best way to buy rentals.
Thanks, guys.
Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast, or the compliance with the applicable laws of such materials and/or links referenced herein.